Good morning, everyone. Uh, Welcome to our webinar. This is a new webinar for us, Insuring Community Associations, planned PUDs, planned unit developments. My name is Anae Augustini. I'm CEO of CID Insurance Programs, and we are lucky to have Christine Hazard of USLI, who's a specialist in this area, and she's going to be instructing our webinar today, so you're in for a treat. Also with us, we have Michelle Belden, who is our commercial underwriter who handles our PUD program. And of course, last but not least is Jacob Cole, who's our marketing specialist, and he works behind the scenes to make sure that everything runs smoothly. So I'm going to introduce Christine Hazard and let her take it away.
Thank you very much, Anae. And thank you, everyone, for coming and attending today. I'm very excited to be here. I've been with USLI for about 16 years now and working on the nonprofit and community associations for most of my career. And I do enjoy the sector a lot. There's a lot of interesting things going on, a lot of changes. But today, what we're going to talk about is really the opportunity. Why do we even talk about community associations as a separate sector? And just really understanding the differences between the different types of associations that are out there, with really a main focus on PUDs or planned unit developments. And then we'll talk about the features and advantages and the easy ways that you can get a quote. I challenge you, this will probably be the easiest group you can work with and the most experienced group in the world of PUDs through CID. So the opportunities, there's over 347,000 community associations in the United States. Most Americans do live in some sort of association-governed community. And in the West, it is a significant area of opportunity as well. And most of these community associations are managed by a property management company, though they don't necessarily have to be. But with that, different property managers can be a great touch point to multiple associations and really help them find a consistent way from an insurance standpoint of addressing a community association's needs. Now, there are a variety of different types of associations out there. You're going to hear a lot of these terms, and they've been used interchangeably. And homeowners, condos, townhomes, planned unit, property owners, and mobile homeowners associations have definitely some commonality in that, they're run by a board. Their purpose is really to enforce the residential bylaws and really give a consistent living environment for everybody who's a part of that. You're pooling resources to maintain the property. And ultimately, any of your losses and the things that we're going to talk about today are really going to be addressed by when those responsibilities fail and when there are issues with that commonly owned property. Now, there are challenges, of course, with placing homeowner associations. I would say, commonly an agent is forced into putting together a lot of different applications, maybe accords, maybe specific carrier applications, supplementals, and then you're getting pictures of the property. You're trying to get the loss runs together and everything. At the end of the day, it really gets to be very difficult if you have to get multiple options for your insured, for your applicant. And then with that, since there are lines like property, general liability, directors and officers, crime, all of these different things, you very well could have multiple underwriters handling the various lines of coverage and not necessarily coordinating. They could be with different companies, and it can be a very difficult process. The other thing that's interesting is that I would say in the homeowners association world, it is a bit of an unstable marketplace. Since there are so many associations in the United States, a lot of carriers identify this as a very profitable, lucrative area to target. But they come in, they have very little experience. They create these programs where the coverage changes a lot. It may be underpriced, and then all of a sudden they realize they've got in over their heads, and then they leave. So you see this almost 3-year cycle of different players coming in and out. I will share that between CID and USLI, we've been a stable partnership in this world for over 20 years. So it's not something you need to be concerned about, us jumping in, jumping out, and having significantly erratic changes in pricing. But ultimately, I think the biggest complaint we do here is sometimes it's too long to get a policy or an even response, and we want to squash all of that. Together, we can really fix all of these problems. We have a simple process. We have one underwriter handling all lines of coverage. We have stability. And, our goal is to get you a response as quickly as possible. So homeowners associations are a unique area within this. I would say planned unit developments fall within this world. And when I say homeowners associations, I'll take a quick step back. And what's the distinction between that and maybe others? Well, there's probably two main categories we'd consider to be condo versus a homeowners association. We fit things into homeowners associations really when the association itself is not responsible for insurance and maintenance of the residential property. So meaning like a condo building, when you have the building, the association has to procure insurance for that building. In a homeowners association or a PUD, a townhome association, most times that individual homeowner is addressing the coverage for that residential property, and the association is left to just really cover all the commonly owned structures. So, what would you consider to be a property component when you're trying to address the different parts with a homeowners association? Well, this can really be any of that commonly owned property, such as a clubhouse, cabana, a kiosk, a fence. There could be entry gates, really anything, a sign that really reflects the association. These are the things that an association has to make sure that they address and that they cover, because it's things that everything that their dues pay for, and you want to make sure that they maintain, that they are maintained. And then in regards to the general liability exposures, this is another area that you have to be concerned about. You have anything that can really create any sort of bodily injury. So really we want to, when you're sitting there and assessing what needs to be covered, consider what physical liability exposures does the association have. Perhaps they have amenities such as pools or diving boards. They might have streets or walkways. They could have trails. And then, of course, there's also things like security guards who are providing a service on behalf of the organization. But really anything that you could think of that will impact the potential for sort of bodily injury in regards to the association's concerns, these are the things that you really want to make sure that they're scheduled and addressed within the coverage. And a broad general liability carrier will be able to do that for you. And you can see here, just like, we have some tennis courts and pools. They're pretty representative of what most of associations have. Now, when looking at what you need to underwrite that and the overall exposures of either planned unit development or homeowners association, you need to know the number of homes. You need to determine whether or not there are rental units. Now, if they have the rental exposure, this increases the potential for injury. And reason why is because when you have somebody who lives there not on a full-time basis, potentially short-term, potentially it just might be an annual rental, they may not be as familiar with the property. They may not know that the lights shut off at a certain time, or the sprinklers come on at a certain time, or that railing is missing from one part of the stairs. And so we see a significant increase in potential general liability occurrences when there are rental units. So that if there are rental concerns, you're going to see that rate increase. Similar with short-term, you have people who are not familiar with the property. They're there and they're in vacation mode. And they just may not be aware of all their exposures. We're going to look also at loss history, because this will determine to us how well they're managing the property. If there's a frequent number of losses, that's going to make it more difficult to place coverage. If there's one or two and they show that they've really corrected all of those concerns, you'll have a much better chance at getting the coverage that will be what they want. From a property standpoint, we look at construction type and the total insurable values for each piece. So, that $5,000 sign and what the mail kiosks may be, all those different things need to be accounted for. Now, together, we have a very, very broad appetite. We can do up to 1,000 homes with the homeowners associations, and all amenities typically are acceptable. I think the only things that I think of where we have some issue might be where if they have something like a water park, a very unusual exposure, or something that's open to the public, that we're going to have to look at very closely or may not be able to do. But your typical amenities that most associations have are well within what we're able to do. The number of rentals, we're looking really up to 50% rental to be acceptable. And short-term rentals can be acceptable in the state of Texas and certain other areas. And we want the building to, or not the building, excuse me, the entire association to pretty much be constructed. It gets to be difficult, and there are potential issues when the builder developer is still owning most of the property or still developing most of the property. In an ideal world, we'd like the association to be pretty stable, pretty set up, control has been transferred, and the builder developer is working their way off of the board, and you know, that process is almost done. That is typically your ideal and most likely to bind association. Now, from a coverage standpoint, what we have available, we do property up to $1.5 million in total insurable value. Now, this is just for this package product. CID is going to have options available broader than that, but here for, you know, that ability to phone quote or web quote, that would be a $1.5 million in total insurable value. We can do that for residential condo units, clubhouses, really any of the outside property, which is a nice advantage. Not every carrier is going to want to cover all of those different things that are out there with the elements. From a general liability standpoint, we have the advantage of no deductible. So there's no general liability deductible on our coverage offering. We include higher non-owned auto. We have the unit owners automatically as additional insureds, and the property managers as additional insureds. Some things also to note is that, you know, the association may have some off-premise. They might have some off-premise. Those would automatically become any association has. Maybe they have a block party. Maybe there's a yard sale. They might be doing an annual holiday event. That is something that we can, and we do automatically consider and also include the host liquor for that. We can provide the special form on that outdoor property and a blanket agreed valuation on non-building structures. Now, from a community association professional standpoint, this is really a key element to the coverage that something can be potentially overlooked from time to time. Now, serving on a board is a big exposure. You're potentially putting your personal assets at risk for the decisions that you make. And then I always like to look at the flip side of what really are the exposures and what is the potential for a lawsuit or claim from anybody who might be in an association. And I'm not going to say it's high, but it is a possibility. When you think about association living, these are people who are obviously living in their permanent home. It's the law they have, and they are going to protect it vehemently. So that is a good chance to see something happening across the street that impacts the value of their home very well. Their lawsuit. It's not just going to make a complaint about. And so in that case, you really want to look and make sure that the profitability or the directors and officers that you have in place for association is robust. And it does cover as many potential perils as possible. It has a broad coverage form. And I could definitely tell you that is the approach we have taken as a company for decades now. We have a lot of features listed here. I'm not going to go through them all because, you know, I don't want to get everything, but we'll hit some of the highlights.
Kristen, can I interrupt you just for a moment? It seems like your microphone is shorting out. Kristen? Are you there, Kristen? Kristen? Are you there? Kristen? Are you there? Sorry for the problem. It's a technical problem. Oh, great. Thanks. While we're fixing that, are you there?
Yeah, I'm trying to use the computer audio instead of the phone. Does that work better?
Yes, that's better. Thank you.
I apologize there. Okay. So getting back to the concern here now with the community association professional, we'll hit on some of the major highlights of the coverage. So there are some bigger areas that you should be concerned about in making sure that the coverage is addressed. That could be things like non-monetary claims as well as breach of contract claims. And you can see that the non-monetary and breach of contract represent a majority of the claims that impact an association. These are also things that very well could be excluded from other coverage forms. Now, non-monetary examples could be things like challenging elections. It could be concerns about architectural review. Potentially, you may have another member of the association wanting to build on their house, and that's something that can be challenged. As well as breach of contract as a concern, you have a volunteer board that may have trouble trying to make the best decisions as possible, and they may break contracts with vendors. Now, we're not covering the potential money that is due to the vendor, but what we will do is defend the association, trying to prove that they were making the best decisions possible. And finally, discrimination, that comes up in play, and you really want to make sure that you have things like third-party discrimination coverage in play, as well as just discrimination as a potential covered peril. We see now a lot of people who have therapy chickens, therapy pets, and when bylaws may state that they're not allowed to have those, it can be a concern, and they have rights, you know, if that animal is designated as a therapy animal. We also will have the lifetime occurrence reporting provision, which happens to be a unique feature for us. It gives an occurrence feature to the claims made form. We give this as a coverage that is for no additional premium, and it's an automatic tail that is added for an individual director or officer.
Kristen, could
Yes.
you, because I think we're okay on time, someone was asking to go back to not this slide, one, I think it would be 2 back, right there, I believe, yeah, this section here. They wanted just a little bit more information on the D&O section, I think.
Sure. All right. Well, we can start right here. Apologize for that. It's all these little.
No worries.
So, you know, some of the key features that you need to be concerned about from a directors and officers standpoint are readily available, and you may have an opportunity to get those automatically like you would with USLI's coverage form, or you may have to ask for them with other carriers, or they might also not be available with others. We do offer currently unlimited defense costs outside the limits of a liability. And we're going to go into more detail about the non-monetary and breach of contract, as well as lifetime occurrence reporting provision. We also automatically include the property management extension, which means that your property manager is automatically going to be looped into this coverage form. We also offer that third-party discrimination harassment, as well as a data and security endorsement, which is a nice little added piece if they have maybe a website where they're collecting dues from, or concerns like that. Now, when we look and we break down claims activity, we do see that a majority of the claims that impact an association tend to fall within 2 categories. That's non-monetary claims and breach of contract. Now, when you think of non-monetary claims, it's really how the form itself defines its coverage. So from a standpoint of a typical claim may come in, let's just say bodily injury. Somebody trips, falls, they break their leg, they suffer about $10,000 in medical payments at the end of the day. They're going to sue the association for $10,000. They're asking for a financial settlement. But when it comes down to non-monetary claims, they're not necessarily asking for a financial settlement. So if you have a non-monetary claim and you're using a form that doesn't define claim as something covering non-monetary actions, you're really going to be out of luck. Now, those claims come out as a variety of different things. It's when people want injunctive relief. They want something to change. They don't, like I said, necessarily want a financial settlement. That can look like something as simple as a neighbor who may repair their car in the front yard, and it's an eyesore and everybody wants it removed. We're asking for that car to be removed. We're not asking for a financial settlement. Or it can be to challenge, as the elections have gone, it can be to challenge the architectural review committee who may be approved building a third story to a building that now, with that new structure, it's now blocking somebody's view. So again, coming back to that concept and thought, this is the biggest asset that somebody's ever going to own. They're going to protect it vehemently. There's a good chance that someone will bring action because they want the board to do something. With breach of contract, that comes into play really because you have an association who's providing a lot of services to its community members. And with that, you have to have vendors that provide that. And so as a volunteer board goes, they may or may not always make the best decisions, but they're trying in all likelihood. I like to give the example of, they have the deck that's on the clubhouse and they need to repair that deck. And they have a meeting and they decide to hire one construction company to come in and repair the deck. And they sign the contracts and everything's great. And then the next meeting they go over the minutes from the last meeting and somebody who wasn't there says, oh, my brother can do that for us and he'll do it really cheap. And everybody else agrees that that's a great idea, but then they forget to actually deal with the other construction company that they'd already hired. And then it gets very confusing because potentially that initial contract, they're gonna wanna get paid. So at the end of the day, the way the coverage applies is it's not that we're covering the money that's due to that vendor or that contractor. We're instead there to defend them when legal action is taken and prove that they were making the best decision they could possible. A lot of other carriers just flat out exclude it and say it's not insurable. And then finally, with discrimination, that is a hot topic within the world of community associations today. And I have this chickens example here, and really what this is sometimes people will have an animal and it may be causing disruption to the other association members. It may be against the bylaws to have that animal, but that person can then prove that they have this animal there as a therapy animal. And that is one of our larger claims involving chickens, where a woman had a significant number of chickens on her property and claimed that they were therapy chickens. And it was a long, lengthy battle and involved a lot of other allegations as well. But it is something that comes up pretty frequently, and you want to make sure that your policy has coverage for that aspect. And then finally, again, with that lifetime occurrence reporting provision, that protects individual directors and officers. And it really comes into play in the event that a future board chooses to cancel or non-renew and the association is potentially bare. And when that happens, you'd want to make sure that you're covered for the decisions you've made in the past. This gives a lifetime tail to that individual director or officer to protect them for those decisions they're made in the event that the future board cancels or non-renews coverage. So I hope that answers any questions. If there are any specific D&O or professional liability questions, I'm happy to answer those as well. But ultimately, with this process, our goal is to really make it very, very easy. We have the ability to quote any community association over the phone. You can also get a quote online. Just go to CID's website, and there's a web chat feature that will, connect from an instant message standpoint to an underwriter, and they can help you walk through any of the questions that might be confusing right then and there. The nice benefit, though, is that you don't have to fill out an application. So you can get a quote and never fill out an application. Once you do get the quote from us, it will come with a pre-filled application with everything that we already know. But it also gives you an opportunity to speak to an underwriter and really share the very positive benefits of the association. And really no accord form is needed. And again, just to reiterate what we need to quote, you just need to know the number of homes and units, the types of amenities that the association may have from a property standpoint, the values, the description of the property that needs to be covered, and then from a directors and officers standpoint, the number of homes and the number of employees, if they have any, for the association. And then just really quickly, when you do quote online, there's a very key question I like to point out. We talked about this in the beginning, but it really determines the class that fits within, how this is classed ultimately. So it doesn't matter what type of association you select, this question here, who is responsible for insurance and maintenance of the residential building, ultimately determines whether this gets to be seen as a homeowners association, which has a preferred rate and is a lower hazard class, or it's a condo association. And really, if the association is responsible for insurance and maintenance of the residential buildings, then it really fits into that condo world. If the individual unit owners are responsible, then it fits into the homeowners association world. Just do not pick unknown. It's going to automatically assume that it's a higher hazard. This can be found in the bylaws, and it ultimately determines the class and pricing. And then finally, what do you need to bind? You're going to get the quote. It's going to have, after all of what's due, it's going to show you some items. There's going to be a prior to binding section. This is really, and you can see it highlighted here on this slide, this prior binding section is showing what you need to prove from an eligibility standpoint. So if you know any of these things and you're looking at it and you're saying, well, geez, this association, they don't have any smoke detectors in the hallways of this condo building, well, then you're going to know that that's going to be an issue and it's not necessarily going to qualify for this quote. The section below it where it shows within 21 days, this is just dealing with the applications that we'll need within 21 days. And then the last section will be underwriting notes. And this is a good place to always check because it may show you where there might be potential credits available for you. But thank you so much for joining us. I'll turn it back over to Anay.
All right. Thank you so much, Kristen. That was really valuable information, and we greatly appreciate you sharing your wisdom with our brokers today. I don't see any other questions, but feel free. You can still send us questions, and we will make sure we get an answer back to you. Jacob's going to be sending out some tools. We have a risk profile that you could gather information to get these quotes from, and that's fillable. That's on our website. Also, the quoting that Kristen talked about is for phone and web with chat option. Right. You can find that on our website as well. It's right on the home page, easy to see because it's right there. And then, if you've got any questions relative to, a risk that you would like to talk about, Michelle, email Michelle directly, or you see her phone number on the screen as well. You can find her on our website as well. And then we'd love to get started with you. Michelle would like to do some quotes for you, so send that over to submissions@cidinsurance.com. You can copy Michelle if you want when you send it in as well. So thank you so much for joining us, and have a great afternoon or morning, depending on where you are. Take care.